Valuations for some of the biggest beneficiaries of that AI rally have dropped to their pre-Chat GPT levels amid yet another risk here. Jack Ma's backed Ant, the company touting an AI breakthrough using Chinese chips and AMD chips as well. Meantime, top executives from Apple, Qualcomm, Eli Lilly, and more gathering in Beijing for the China Development Forum. So what's next for the big tech trade? Joining us now, Sarah Kunst, Cleo Capital Managing Director. Sarah, we always love chatting with you. Thank you so much for being here. So these tech valuations dropping back to their pre-Chat GPT levels. What would you say is the biggest risk right now for the large cap tech names? Is it U.S. specific risks in the form of policy, or is it a tech-specific risk coming from all this competition bubbling up?
So I think it's actually something a little bit different, which is that tech is not a monolith, right? And I say that and the market ignores me. And what I mean by that is that it's not the same, right? Tesla's big risk is, besides the Molotov cocktails, is that people don't necessarily want to buy the exact same sedan that they've been able to buy for what feels like a decade now, right? So they have a product risk and a CEO risk, whereas you have names like Alphabet, where I think their risk is certainly not in tariffs. It's not in physical goods because they don't sell that. It's in other more existential things like, are we actually going to use search in a world of AI where we go to an AI chatbot first to ask questions? And so what's that going to do to their advertising business? So these aren't a monolith, and some of them have tariff risk, some of them have tech risk, valuation risk, PR risk, but you really have to look at them as individuals, not just a basket.
So Sarah, within all of that and looking through the monolithic narrative, as you point out, where are you seeing opportunity? Where would you say public investors, this is the spot where there's a window to put some money to work?
So I actually do really like Alphabet. Like I mentioned, I think that they have this question mark of, if search declines and that ad revenue declines, what do they do for money? But they are an incredibly prolific, very smart company and team. And so I think it matters that the odds now that they get broken up the way that the last administration was talking about, those odds are probably pretty close to zero now. It's unlikely we're going to see a Chrome spinoff. So I think that is a good thing for them. And if they can figure out sort of, hey, how do we take all these really fascinating businesses like the Waymos of the world, like DeepMind, and actually make some real money with them, I think that there's a huge opportunity for them.
And Sarah, on the flip side of that, what's a name that you are avoiding right now?
I have to say, I can't call myself a Tesla bear, because being a Tesla bear is probably the best way to lose money. But I am always bad and continue to be a Tesla skeptic. And I think that, you look at BYD. I was in Riyadh recently. I was in Mexico City recently. That company is everywhere. The cars are good. They work. They're incredibly affordable. And just because they're not allowed to be sold in America doesn't mean you can discount the, close to 8 billion other people on the planet who are likely, probably in 10 years, much more likely to be driving a BYD than a Tesla. And so, when you look at the valuation of Tesla, one thing I always look at are kind of PE ratios. Tesla's is around 130 right now, whereas Toyota, the world's biggest automaker, is barely above 7. And so if you right size that Tesla trade, you have lost not just your shirt, but your socks. You are swimming naked. And so that is a name that I'm not going to short it, but I'm certainly not going to touch it.
Sarah, you spend a lot of your time in the private side of the tech industry, investing in private companies. What are you seeing in terms of valuations? Have they been tracking these roller coaster swings in public equity tech valuations we've been seeing?
So there tends to be sort of this most popular kid at the party effect in tech, where at any given time, there will be one or two companies where I can call up any of my friends or investors at the biggest funds on earth, and they are chasing that deal. They have seen that deal, right? They are whining and dining that company at crazy nosebleed valuations. And then everything else just sort of sits there. And it'll be something where two people have both spun out of the same, Mag 7 employer, have similar backgrounds. They both started interesting deep tech companies. One's the belle of the ball, the other can't get a call back. And so, the valuations that we saw around Gen AI, that sort of madness, which has definitely died down, was really sort of situated on a couple specific names that all the investors decided, hey, if everybody else is meeting with them, I've got to send them a term sheet with a higher valuation. Less about sort of any deeply differentiated foundational tech or models that those companies were building.
It makes me wonder how you're thinking about the valuation question and any comparisons to the dot-com boom and bust cycle that we saw, Sarah. And we've got a chart here just indicating you can barely even see. We're comparing where we're at right now versus the run-up in some of these big tech names in the dot-com bubble. Just huge run-up in that white line representing the early aughts there versus your green line barely even tracking that white one on your screen for those watching right now. Sarah, what do you make of those comparisons in terms of valuation concerns that we are at a dot-com boom level with the AI rally right now?
You have to remember that in the dot-com boom, I mean, we probably don't remember, right? We were not exactly trading then, but you have to remember that at the time, these were companies that were literally just, hey, I have a pitch deck. I'm an MBA with a pitch deck, and I'm going to go IPO because I need to raise hundreds of millions of dollars to even really launch a website, right? And so certainly now you can build real tech companies. You can be a very smart person building a very real company on very, very, very little money. So no, this is not the dot-com boom, which is probably a little bit more like, the tulip craze in Amsterdam hundreds of years ago. But at the same time, I think you do have to keep an eye on looking even at your own life and your own businesses. Where are you spending your money on things like AI, right? And how is that actually going to work? What would get you to spend hundreds or thousands of dollars a year in your personal or professional life on AI? Because if you're not doing that, then you do have to wonder, how are these companies actually going to make money? You see OpenAI, will come out with new models, and it started at kind of tens of dollars a month, and now it's hundreds of dollars a month. Really? Just so that I can get like an incorrect recipe instead of Googling it? That feels expensive to me.